Guys, during the internet bubble, so many companies' stocks skyrocketed after they said they were going to be e commerce or they were adding a .com to their name. Is this now happening with AI? The evidence says it is. So the market was up big on Thursday, and they say it is another brutal short squeeze in one of the market generals, this time Facebook or Meta AI, which just hit a 52-week high, up 15% because while their earnings dropped 20%, they mentioned AI 57 times. And since a handful of AI exposed stocks is all that matters, the bears are falling like flies, as is the VIX, while 0 day to expiration calls are surging. Right, here's a look at the calls, 1.19 billion versus 256 million puts. And intraday, the VIX is actually dropping, but this new 1 day VIX product is actually increasing. And why is that? Probably because there are a lot of net non-commercial shorts on the E-mini S&P futures. And so you see these short levels have not been seen since about 2011. So any kind of good news in the so-called market generals is going to induce a short squeeze. And so they say, once again, getting steamrolled by today's squeeze, JP Morgan has a daily warning that the stock ramp is unsustainable and listing the four most concerning trends in today's market. So the narrowest stock leadership, this is something to pay attention to. Market cap of the 10 largest stocks relative to the S&P 500 is at the 96th percentile relative to history. And the weight of the largest two stocks as a percentage of the S&P is at new highs. Single stock concentration near 30-year highs, and only 28 stocks explain all of the market gains year to date. That is the narrowest leadership for an up market since the 1990s. So number two, he says extreme concentration in growth. So AI, large language model, LLM theme appears to be stretched with market cap creation of 1.4 trillion and a gain of 45% year to date. So year to date, the 6 LLM companies, Microsoft, Google, Amazon, Meta, NVDA, and Salesforce explain 53% of the S&P 500 performance and 54% of the Nasdaq 100 and 68% of growth factor. They say defensive rotation is underway outside of some outperformance at the start of the year on short covering. The fact the rotation into defensive low volatility has been persistent. And they say that this rotation is only about a third underway when compared to prior end of cycles. They're saying the current degree of crowding implies the risk of recession is far from priced in. And defensive rotation and narrowing growth leadership is typically indicative of a slowing cycle / recession. And number four is a weaker macro backdrop versus 2021. So in 2021, a broad market rally led by cyclical factors, growth in value, drove concentration to the highest level. With the S&P with a forward PE of 19, still could be a higher level even at lower rates, let alone one where the growth outlook is diminishing. Monetary policy is tight with risk-free yielding 5%, and event risks are increasingly disconnected from the VIX. And so here's a chart of how concentrated the top 10 stocks in the S&P are. So those top 10 stocks make up 28.7% of the value of the S&P 500, and it has only been higher just recently in 2022, still a lot higher than even the great financial crisis or the internet bubble. Yet the weight of the other stocks, 11 to 50th stocks in the S&P, are at 35.2%, which is the 24th percentile, right? So those other 40 stocks, the next 40 biggest stocks in the S&P 500, are historically way down here when they're usually a lot higher. Even during the internet bubble, they reached somewhere like 47%. So it is very hard to have a broad rally when the rally is being supported just by the top few stocks in the S&P 500 and the rest of them are not following along. And so they say how to trade these concerning trends. JP Morgan baskets courtesy of the bank's elite Delta One team. So basically, one of the ideas is to buy those 11 to 50 stocks by size in the S&P, the ones that are lagging, and short those top 10 stocks. Now, I'm not saying you should go ahead and follow JP Morgan's trade advice or whatever, do your own research, but be careful out here because 10 stocks can't carry the whole stock market up to new highs forever. So this feels like a really strange period we're in where these stocks are getting squeezed higher and higher, only the big names, while the other stuff, the general majority of it, are not doing much of anything. Just remember, these historic anomalies don't go on forever and they eventually revert back around the average. So be aware of that if you're holding some of these or if you're thinking of buying some of the high flyers just because they say AI a whole bunch of times. People have inflated ideas of what their stocks are going to do because of that. Thanks for watching, guys.